everyone, welcome back to the Chill Vibe and Money Mindset channel. Today, we're diving into something that's going to flip the way you think about money upside down. We're unpacking 8 mind-blowing lessons from The Psychology of Money by Morgan Housel, a book that's less about spreadsheets and more about what's going on in here, point to head. Because let's be real, money isn't just numbers, it's emotions, it's habits, it's the wild stories we tell ourselves. Whether you're saving your first dollar, investing in crypto, or dreaming of millions, these lessons are your secret weapon to outsmart the game. Housel doesn't just throw theories at you, he hits you with real-life examples and truths that stick. And trust me, by the end of this, you'll see why financial success isn't about being the smartest guy in the room, it's about how you behave with money. I've cherry-picked 8 of his best insights from the book's 19 chapters, and we're going deep. So grab a coffee, a notebook, whatever you need. Let's break this down and turn your money mindset into a superpower. Ready? Here we go. All right, let's kick things off with lesson 1, and this one's a biggie. Housel says no one, and I mean no one, thinks about money rationally. Not you, not me, not even the billionaires. And that's where we start. From there, we'll unpack why wealth isn't what you think, how time is your real MVP, and why chasing the wrong things can tank your dreams. Each lesson comes with examples, like Depression-era savers versus Bitcoin FOMO chasers, and practical takeaways you can use today. So, let's jump into the psychology of money and figure out what's really driving your wallet. First up, no one thinks about money rationally. Key idea. People don't make financial decisions purely based on logic or numbers. Instead, their choices are shaped by emotions, personal experiences, upbringing, and psychological biases. This means 2 people with the same financial knowledge may still make completely different decisions about money. Morgan Housel argues that your financial worldview is shaped by your unique life experiences, not by facts or spreadsheets. This explains why some people fear investing while others take extreme risks, even when they have access to the same information. Your personal experiences with money make up maybe 0.0000001% of what's happened in the world, but 80% of how you think about money. Morgan Housel. Examples and real-life applications. 1. Your financial mindset is shaped by your life experiences. 2 people can live in the same country at the same time, but have totally different attitudes toward money based on their past experiences. Example. Person A grew up during the Great Depression 1930s, a time of widespread poverty, unemployment, and financial instability. They saw people lose everything and struggled to afford basic necessities. As a result, they develop a scarcity mindset. They avoid risks, distrust banks, and prefer to save money in cash rather than invest. Person B was raised in the 1990s, during a period of economic growth and booming stock markets. They saw stocks go up consistently and believe investing is the best way to get rich. They are more comfortable taking risks and assume the market always recovers. Same world, different experiences, different financial mindsets. Real-life example. Mark Cuban versus Warren Buffett. Mark Cuban, billionaire investor, is known for keeping a large amount of cash on hand because he sees liquidity as freedom. Warren Buffett, on the other hand, invests nearly all his money in stocks because he believes in long-term compounding. Neither approach is wrong. They just reflect different experiences and risk tolerances. 2. Emotions play a bigger role than logic in financial decisions. Even the smartest people make irrational money decisions because fear, greed, and overconfidence cloud their judgment. Example. During the 2008 financial crisis, many investors panicked and sold their stocks when prices crashed, fearing they would lose everything. However, those who held onto their investments saw them recover and grow in the following years. Logically, the best time to buy stocks is when prices are low, but fear causes most people to do the opposite. Real-life example. Bitcoin and FOMO, fear of missing out. In 2017 and 2021, Bitcoin reached all-time highs, and many people rushed to buy it out of excitement, without fully understanding the technology. When Bitcoin crashed later, many of these investors panicked and sold at a loss. The decision to buy was driven by greed, and the decision to sell was driven by fear. Neither was rational. 3. People judge money based on their own perspective, not reality. Our beliefs about money are often shaped by a very limited personal experience rather than objective facts. Example: someone who has never struggled financially may not understand why others are afraid of losing their job or saving excessively. Someone who grew up in a family with high debt might avoid credit cards altogether, even though responsible credit use can be beneficial. Someone who became rich from cryptocurrency might believe it's the future of finance, while someone who lost money in crypto might think it's a scam. Real-life example: the 2008 crisis changed an entire generation. People who graduated during the 2008 recession often struggled to find jobs, had student loan debt, and saw home prices crash. Many of them became extremely cautious about investing and homeownership because of that experience. Meanwhile, younger investors who entered the market after 2010 only saw a bull market, making them more optimistic about stocks. Neither group is wrong. They are simply shaped by different financial environments. Key lessons and takeaways. 1. Everyone has a different view of money. No two people see money the same way because their experiences are different. What seems risky to one person might seem safe to another. 2. Feelings influence financial decisions more than numbers. Fear, greed, optimism, and past trauma impact how we save, spend, and invest. Avoid making financial decisions purely based on emotions. 3. Luck and timing play a bigger role than we admit. Success in money is often about when and where you were born, your early experiences, and what financial world you grew up in. Instead of assuming that everyone should make the same financial choices, understand that people's decisions come from their unique life stories. 4. Recognize your own biases. Ask yourself, am I making this financial decision because of logic or because of my emotions and past experiences? The more self-aware you are about your financial psychology, the better decisions you'll make. Final thought. No one makes financial decisions in a perfectly rational way. We are all shaped by our own experiences, emotions, and biases. The key to financial success is not just knowing numbers, it's understanding how your own psychology affects your decisions. 2. Wealth is not equal to high income. Key idea. Many people assume that being wealthy means having a high income, but that's not true. Wealth is not about how much money you make. It's about how much you keep and grow over time. Someone earning $500,000 per year, but spending it all is not wealthy. They are just high-income earners with no financial security. Meanwhile, someone earning $50,000 per year, but saving and investing consistently can build long-term wealth. Morgan Housel explains that wealth is invisible. It's the money you don't spend, the investments you hold, and the financial security you build over time. Wealth is what you don't see. It's the option to buy something later. Morgan Housel. Examples and real-life applications. 1. Wealth is hidden. Income is visible. Income is what you earn your salary, bonuses, commissions, or business profits. Wealth is what you accumulate, your savings, investments, assets, and net worth. Example. Imagine two people. John earns $500,000 per year, but spends it all on luxury cars, expensive vacations, and a big house. His bank account is nearly empty. Sarah earns $80,000 per year but saves and invests 20% of her income every year. After 10 years, she has over $500,000 in investments. John has high income, but Sarah is actually wealthier. Real-life example. Many professional athletes and celebrities earn millions but go bankrupt because they spend recklessly. Meanwhile, Warren Buffett still lives in the same modest house he bought in 1958 despite being one of the richest people in the world. He focused on building wealth, not just earning high income. 2. The difference between being rich and being wealthy. Morgan Housel differentiates between rich and wealthy. Being rich equals having a high income and spending a lot. Being wealthy equals having financial freedom, savings, and assets that grow over time. Example. A person driving a Lamborghini and living in a mansion may look rich, but if they have huge debts and no savings, they are not truly wealthy. Meanwhile, a quiet millionaire next door who drives a regular car but has a multi-million-dollar investment portfolio is truly wealthy. Real-life example. Ronald Red, a janitor and gas station attendant, never had a high income. But through decades of saving and investing wisely, he built a $8 million fortune without anyone knowing. Mike Tyson, a world-famous boxer, made over $400 million in his career but went bankrupt due to overspending. Income can disappear quickly, but true wealth lasts. 3. High earners can still be broke. Just because someone makes a lot of money doesn't mean they are financially secure. Many high-income individuals live paycheck to paycheck because they increase their spending as their income grows. Lifestyle inflation. Example. Doctors and lawyers often earn six figures, but many are deeply in debt from student loans, mortgages, and expensive lifestyles. Many Silicon Valley executives earn high salaries but spend everything on luxury goods, making them vulnerable if they lose their jobs. If you always spend what you earn, you will never build real wealth. 4. The key to wealth: saving and investing. Morgan Housel emphasizes that the biggest factor in building wealth is not how much you earn, but how much you save and invest. If you save and invest 20% of a $50,000 salary, you will accumulate more wealth over time than someone earning $200,000 but spending everything. The power of compound interest allows small, consistent savings to grow into massive wealth over decades. Example. Ann and Tom both earn $100,000 per year. Ann saves $20,000 per year and invests it at 8% return. Tom spends everything. After 30 years, Ann has $2.5 million, while Tom has nothing. Your savings rate matters more than your income level. Real-life example. Warren Buffett and Jeff Bezos. Buffett's investing success isn't just because he is smart. It's because he has been investing since he was 10 years old and let compounding work. Bezos, Amazon founder, became a billionaire, but instead of spending wildly, he reinvested profits to grow his company and wealth. Key lessons and takeaways. 1. High income does not mean wealth. Many high earners are broke because they spend too much. True wealth comes from saving, investing, and financial discipline. 2. Wealth is what you don't see. A big house, fancy car, and luxury lifestyle do not equal financial security. The richest people often don't look rich. They invest instead of spending. 3. Your savings rate is more important than your income level. No matter how much you earn, if you don't save and invest, you won't build lasting wealth. A person earning less but saving more will accumulate more wealth than someone who spends everything. 4. Financial independence is the real goal. The purpose of money is not just to buy things, it's to give you freedom and security. True wealth means having enough to control your time and make choices without financial stress. Final thought. Being wealthy is not about earning a lot. It's about keeping, growing, and using your money wisely. Focus on financial freedom, not just high income. 3. The power of compounding. Key idea. Compounding is one of the most powerful forces in building wealth. It allows money to grow exponentially over time as returns generate more returns. Compounding happens when your earnings, interest, dividends, or capital gains generate more earnings over time. The earlier you start, the more powerful compounding becomes because time is the key factor in maximizing returns. Morgan Housel argues that compounding is the single most important factor in wealth accumulation, yet most people underestimate its long-term impact. Compounding is like planting a tree. The earlier you plant it, the bigger it grows. But you must be patient. Morgan Housel. How compounding works. Example, if you invest $1,000 at a 10% annual return. After 1 year, $1,100. After 2 years, $1,210. After 10 years, $2,593. After 50 years, $117,390. Even though you never added more money, your original $1,000 grew 117x because of compounding over time. Formula for compounding equals 1 plus power of where A equals future value, P equals initial investment, R equals annual interest rate as a decimal, T equals number of years. The longer the time frame, the greater the impact of compounding. Examples and real-life applications. 1. Warren Buffett's wealth came from compounding. Warren Buffett, one of the richest investors in history, built his wealth not just by being a great investor, but by investing for a very long time. Example: Buffett started investing at age 10, and by age 30, he had $1 million. By age 60, he had $3.8 billion. By age 90, he had over $100 billion. 99% of Buffett's net worth came after age 60 because of the power of compounding. If Buffett had started investing at 30 instead of 10, his net worth would be a fraction of what it is today. 2. The story of two investors, Alice versus Bob. Alice starts investing $5,000 per year at age 20 and stops at 30, investing for only 10 years. Bob starts investing $5,000 per year at age 30 and continues until age 60, investing for 30 years. Both earn a 7% annual return. Results at age 60. Alice, who invested for only 10 years, $600,000. Bob, who invested for 30 years, $540,000. Alice invested less money but ended up wealthier because she started earlier, allowing compounding to work longer. 3. Small, consistent investments can lead to massive growth. Many people think they need a lot of money to invest, but compounding works best when you invest small amounts consistently over time. Example: if you invest $10 per day, $300 per month, at 8% annual return, in 30 years you will have $447,000. You only contributed $108,000, but compounding grew it by more than $300,000. Wealth is built not by big one-time investments, but by small, consistent contributions over time. Why do most people fail to take advantage of compounding? They start too late. Many people delay investing because they think they need a lot of money. But time is more important than the amount invested. The earlier you start, the bigger the impact of compounding. They chase quick profits. Many investors focus on short-term gains instead of long-term growth. They panic during market crashes and sell their investments, interrupting compounding. They underestimate the power of small contributions. People think saving $5 or $10 a day won't make a difference, but over decades, it can grow into hundreds of thousands of dollars. They withdraw money too soon. Many people cash out their investments too early, losing the full benefits of compounding. Patience is key. Compounding works best when left untouched for decades. Key lessons and takeaways. 1. Start as early as possible. Even small investments can grow into a fortune if given enough time. The biggest mistake is waiting too long to start. 2. Stay invested for the long term. The longer you let money compound, the more exponential the growth. Avoid panic selling during market downturns. 3. Small, consistent investments matter. You don't need to be rich to invest. Just invest small amounts consistently over time. 4. Let money work for you. Compounding works best when you don't touch your investments. Reinvesting dividends and interest accelerates growth. 5. Time is more important than high returns. A moderate return, 8 to 10%, over 40 years is more powerful than a high return, 20%, for only a few years. Focus on consistency and patience instead of chasing big profits. Final thought. Compounding is the most powerful tool for building wealth. The key is to start early, stay invested, and let time do the work. 4. Knowing when to stop, avoiding greed. Key idea. One of the biggest reasons people lose money is not knowing when to stop. Many people become greedy and keep taking bigger risks, even when they already have enough. Instead of securing their financial success, they keep chasing more, often leading to disaster. Morgan Housel explains that true financial success is not just about making money, it's about knowing when enough is enough. People who can walk away from unnecessary risks preserve their wealth, while those who push too far often lose everything. The hardest financial skill is getting the goalpost to stop moving. Morgan Housel. Examples and real-life applications. 1. The story of Rajat Gupta, a billionaire who lost everything due to greed. Rajat Gupta was a highly successful businessman who became the CEO of McKinsey & Company and had a net worth of over $100 million. However, instead of being satisfied with his wealth, he wanted more and engaged in insider trading to make extra millions. He was caught, sentenced to 2 years in prison, and lost his entire reputation and career. Gupta already had enough money to live comfortably forever, but greed led him to take unnecessary risks, and he lost everything. 2. The dot-com bubble. Greedy investors lost everything. In the late 1990s, many investors made huge profits by investing in internet companies. Instead of cashing out and securing their gains, many got greedy and kept investing. Example: in 1999, a tech investor turned $50,000 into $1 million by investing in dot-com stocks. Instead of selling, he kept reinvesting everything, hoping for even bigger returns. By 2002, after the bubble burst, he lost everything. He could have been financially secure, but greed made him take unnecessary risks. 3. The 2008 financial crisis. Greedy banks took too many risks. Before the 2008 financial crisis, banks and investors kept taking bigger risks with real estate and mortgage-backed securities. They already had huge profits, but greed made them push further. Example: many homeowners took out huge loans they couldn't afford, believing house prices would always go up. Banks ignored the risks and kept lending more money, making billions in profits. When the housing market collapsed, banks lost trillions, millions of people lost their homes, and the global economy crashed. If banks and investors had been satisfied with moderate profits instead of chasing extreme gains, the crisis could have been avoided. 4. Knowing when to stop. Warren Buffett versus Bernie Madoff. Warren Buffett. Buffett built his fortune slowly and steadily through long-term investing. He never took unnecessary risks and focused on preserving wealth. Even though he could chase riskier investments, he sticks to his principles. Bernie Madoff. Madoff was a wealthy investor but wanted more, so he created a Ponzi scheme. Instead of stopping when he had millions, he kept the fraud going. When the scheme collapsed, he lost everything and went to prison. Buffett focused on sustainable wealth, while Madoff let greed destroy him. Why do people struggle to stop? The goalpost keeps moving. When people reach a financial goal, they often raise their expectations instead of being satisfied. Someone happy with $1 million suddenly wants $10 million, then $100 million. Fear of missing out, FOMO. Seeing others make money makes people feel like they're falling behind, so they take bigger risks to catch up. This is common in stock market bubbles and cryptocurrency booms. Thinking just a little more will make them happier. Many people believe a little more money will solve all their problems. In reality, after a certain point, more money does not increase happiness significantly. How to avoid greed and know when to stop. 1. Set a clear definition of enough. Decide in advance what level of wealth or income is enough for you. Example: I want to have $1 million saved for retirement and live comfortably. 2. Focus on wealth preservation, not just growth. Once you have financial security, focus on protecting your money, not just chasing bigger risks. 3. Avoid unnecessary risks. Ask yourself, is this risk worth it? Do I really need more, or am I just being greedy? If you already have enough, don't risk losing everything for a little more. 4. Remember that happiness comes from freedom, not just money. The purpose of money is to give you freedom and security, not just a higher number in your bank account. 5. Learn from others' mistakes. Study people who lost everything due to greed, and remind yourself to be cautious. Final thought. Wealth is not just about making money, it's about keeping it. Knowing when to stop is one of the most important financial skills. Don't let greed push you into unnecessary risks that could destroy everything you've built. 5. Luck and risk in money. Key idea. Morgan Housel emphasizes that luck and risk play a bigger role in financial success than most people realize. Two people can make the same financial decisions, but end up with completely different outcomes. One might become rich, while the other might lose everything. Luck is when things go well due to factors outside your control. Risk is when things go badly despite making good decisions. Understanding the role of luck and risk in money helps us avoid overconfidence when things go well. Be compassionate toward those who struggle financially. Make decisions that balance risk and reward. Nothing is as good or as bad as it seems. Luck and risk are two sides of the same coin. Morgan Housel. Examples and real-life applications. 1. Bill Gates, a story of luck and opportunity. Bill Gates became one of the richest people in the world by founding Microsoft. He is undoubtedly talented, but luck played a huge role in his success. How luck helped Bill Gates. Gates was one of the few students in the world with early access to a computer in high school in 1968. If he had been born just a few years earlier or later, he might have missed the personal computing revolution. His friend and co-founder, Paul Allen, happened to share his passion and skills, which made Microsoft possible. Gates worked hard, but luck, being in the right place at the right time, played a huge role in his success. Counterexample, the lost Bill Gates. In the same school as Gates, there was another brilliant student, Kent Evans, who was just as smart. Unfortunately, he died in a mountaineering accident as a teenager. Had he lived, he might have been as successful as Gates, but bad luck took away his opportunity. This shows how luck and risk can determine vastly different life outcomes, even for people with the same talent and ambition. 2. The role of risk. Warren Buffett versus long-term capital management, LTCM. Warren Buffett. Managing risk well. Buffett is one of the most successful investors ever, but he never takes excessive risks. He avoids dangerous financial bets and ensures that even if things go wrong, he won't lose everything. His cautious approach has helped him stay wealthy for over 70 years. LTCM. A hedge fund that ignored risk. Long-term capital management, LTCM, was a hedge fund run by some of the smartest investors in the world. They made high-risk bets, believing they couldn't lose because of their intelligence and financial models. In 1998, a financial crisis caused LTCM to collapse, losing billions in just a few weeks. LTCM took too much risk, while Buffett understood that staying rich is more important than getting rich quickly. 3. The lottery winner versus the frugal investor. Many lottery winners lose all their money because they assume their wealth is permanent, but luck can change quickly. Example. A man wins $10 million in the lottery and spends it all on cars, houses, and parties. Within 5 years, he is bankrupt because he never planned for the risks of running out of money. Meanwhile, a frugal investor who never made more than $60,000 a year but saved and invested wisely might retire with millions. Luck may give you money, but risk can take it away just as fast. Smart financial habits matter more than temporary luck. Lessons from luck and risk. 1. Don't assume success equals pure skill. If you succeed, recognize that luck played a role. This keeps you humble. If others fail, don't judge them harshly. Sometimes bad luck is the reason. 2. Be prepared for bad luck. Even if you do everything right, bad luck can strike. Recessions, job loss, medical emergencies. Always have an emergency fund and avoid taking extreme risks. 3. Make decisions that allow you to survive. Never bet everything on one risky decision. Take smart risks, but ensure you can recover if things go wrong. 4. Focus on long-term stability. Luck may help you get rich, but managing risk is what helps you stay rich. Follow conservative financial principles to build long-term wealth. Final thought. Success in money is a mix of skill, hard work, luck, and risk. The key is to appreciate good luck, prepare for bad luck, and avoid unnecessary risks that could wipe out your progress. 6. Staying in the game matters more than winning. Key idea. Morgan Housel emphasizes that long-term survival in finance is more important than short-term success. The ability to stay in the game, meaning to avoid financial ruin, bad investments, or unsustainable risks, is what allows people to build wealth over time. Many people focus on winning big in investing, business, or careers. However, the key to lasting financial success is not about making the most money in the shortest time. It's about avoiding big mistakes and staying in the game for decades. Compounding only works if you can give an asset years and years to grow. But getting wiped out and having to start over damages the most important force in investing: time. Morgan Housel. Examples and real-life applications. 1. Warren Buffett's biggest advantage: longevity, not just skill. Warren Buffett is one of the greatest investors in history, but his biggest secret is not just skill, it's time. Key facts. Buffett started investing at age 10. By age 30, he had $1 million. By age 60, he had $3.8 billion. By age 90, he had over $100 billion. Why did this happen? Buffett's success isn't just because he's a great investor, it's because he stayed in the game for 80 years. If he had started investing at 30 instead of 10, his wealth would be a tiny fraction of what it is today. Lesson. The longer you stay in the game, the more time compounding can work in your favor. 2. The 2008 financial crisis. People who took too much risk got wiped out. During the housing bubble in the 2000s, many investors took on huge risks by borrowing money to buy real estate. Example. An investor takes out multiple loans to buy 10 houses, thinking prices will always go up. In 2008, the housing market crashes and suddenly he owes more money than his properties are worth. He is forced to sell everything at a loss and loses everything. Meanwhile, a conservative investor who owned only one house and managed debt carefully survived the crash, and when the market recovered, he was still in the game. Lesson. If you take too much risk and get wiped out, you lose the chance to recover and grow over time. 3. The tortoise and the hare. A financial lesson. The classic story of the tortoise and the hare applies to finance as well. The hare, high-risk investor, tries to get rich quickly but takes huge risks. Sometimes he wins big, but eventually he loses everything because he bets too much. The tortoise, patient investor, moves slowly but steadily, never taking risks that could destroy him. Over decades, he builds real, lasting wealth. Lesson. Winning fast isn't the goal. Staying in the game for the long run is what truly builds wealth. How to stay in the game. 1. Avoid risks that could wipe you out. No matter how good the opportunity looks, never take a risk that could ruin you. Example. Don't put all your money into one stock or borrow too much. 2. Prioritize financial security over maximum returns. It's okay to aim for growth, but never at the cost of your long-term financial safety. Example. Keep an emergency fund and avoid risky investments that could force you out of the market. 3. Think long-term. The goal is not to win big in 1 year, but to keep growing for decades. Example. Invest in solid, long-term assets instead of chasing short-term gains. 4. Manage your emotions. Many people make bad decisions when markets crash, panic selling, or when things are booming, fear of missing out. Staying calm and sticking to a long-term strategy is key. 5. Learn from those who failed. Many people who lost everything were once rich. Their mistake? They took too much risk and couldn't recover. Example. Look at famous financial failures, like the 2008 crisis or the dot-com bubble, and learn from their mistakes. Final thought. Winning big once doesn't matter if you can't survive for the long run. Staying in the game, avoiding big risks, and letting time work for you is the real key to financial success. 7. Savings rate is more important than investment returns. Key idea. Many people focus on getting the highest possible investment returns, but Morgan Housel argues that your savings rate, the percentage of your income that you save, is actually more important for building wealth. You can't control the stock market, but you can control how much you save. Even if you have average investment returns, saving a large percentage of your income will still make you wealthy over time. Many people try to chase returns by taking big risks, but the real power comes from saving more consistently. Building wealth has little to do with your income or investment returns, and lots to do with your savings rate. Morgan Housel. Examples and real-life applications. 1. The story of two investors, James and Robert. James, high savings, average returns. James earns $50,000 per year. He saves 30% of his income, $15,000 per year. He invests in a simple index fund with average returns, 7% per year. After 30 years, he has $1.5 million saved. Robert, low savings, high returns. Robert earns $100,000 per year. He saves only 5% of his income, $5,000 per year. He tries to get higher investment returns, 12% per year. After 30 years, he has only $700,000 saved. Even though Robert had double the income and better investment returns, James ended up richer simply because he saved more. 2. Warren Buffett versus lottery winners. Warren Buffett's approach. Buffett never focused on making the highest returns in a single year. Instead, he saved, reinvested, and let his money grow over time. His investment strategy is not about chasing high returns. It's about consistency and discipline. Lottery winners' mistake. Many lottery winners suddenly get millions of dollars, but they don't save anything. Instead, they spend it all quickly and end up broke within a few years. No amount of investment returns can help if you don't save and control your spending. Buffett built wealth by being disciplined with his money, while lottery winners often lose everything due to bad savings habits. 3. The power of frugality. The story of Ronald Read. Ronald Read was a janitor and gas station worker in Vermont. He never had a high income, but he lived frugally and saved aggressively. How he did it? He lived simply and saved as much as possible from his small salary. He invested in blue-chip stocks and let them grow over time. By the time he died in 2014, he had a net worth of $8 million, which he donated to charity. Even with a modest salary, a high savings rate made him incredibly wealthy. Why savings rate matters more than returns. 1. You can control your savings, but not the stock market. No one can predict exactly how the market will perform. Instead of trying to get higher returns, focus on saving more consistently. 2. A high savings rate gives you flexibility. If you save a lot, you don't have to rely on high-risk investments. You have more financial security in case of emergencies or market crashes. 3. Investing returns are uncertain, but saving is guaranteed. The stock market might go up or down, but every dollar you save is 100% yours. A high savings rate is the most reliable way to build wealth. 4. It's easier to save more than to get higher returns. Most investors can't consistently beat the market, but anyone can reduce expenses and increase savings with good financial habits. 5. Savings allows you to invest more. The more you save, the more money you have to invest, which increases your long-term wealth. How to increase your savings rate. 1. Live below your means. Don't increase spending just because your income goes up. Example, instead of buying a new car every 3 years, keep your old car and save the difference. 2. Automate savings. Set up automatic transfers to your savings and investment accounts. Example, if you get paid $3,000 per month, automatically save $600 before spending anything. 3. Avoid lifestyle inflation. Just because you earn more doesn't mean you should spend more. Example, if you get a $10,000 raise, save at least $7,000 of it instead of upgrading your lifestyle. 4. Cut unnecessary expenses. Focus on spending money on things that truly matter to you. Example, cancels and use subscriptions. Cook at home instead of eating out daily. 5. Find ways to earn more and save the extra income. If possible, look for ways to increase your income, side hustles, promotions, freelancing. Save at least 50% of any additional income. Final thought. Investment returns go up and down, but a high savings rate is something you can always control. The key to wealth is not just how much you earn or how well you invest, but how much you save and how consistently you do it. 8. The influence of media and financial news. Key idea. Morgan Housel explores how media and financial news can have a powerful influence on people's perceptions of money and investing, often in ways that are not aligned with sound financial principles. The media, particularly financial news outlets, thrive on creating drama and urgency. This often leads people to make emotional, short-term financial decisions that can hurt their long-term wealth. Financial news, especially in times of crisis, can induce fear, panic, and overreaction. While these outlets may claim to provide valuable insights, the focus is often on sensational stories that distort people's understanding of the long-term nature of investing. If you look at the news long enough, you start to believe the only way to win is to act fast. It's the opposite of how wealth is built. Morgan Housel. Examples and real-life applications. 1. The influence of daily market news. How headlines create panic. Financial news outlets often focus on short-term market movements, the ups and downs of daily stock prices, or political events that could impact markets. Example: the 2020 pandemic market crash. When the COVID-19 pandemic hit, financial news was filled with daily headlines about stock market crashes, widespread economic uncertainty, and potential long-term recessions. Many investors, spooked by the constant media reports, sold off their investments in panic, fearing further losses. However, if you had stayed calm and ignored the fear-driven headlines, you would have seen that the market recovered quickly, and those who sold out of fear missed out on a significant rebound. Lesson: short-term news and market fluctuations can drive you to make emotional decisions, like selling stocks, which can hurt your long-term financial growth. 2. The 2008 financial crisis. Media sensationalism. During the 2008 global financial crisis, media outlets focused heavily on doom and gloom stories, amplifying fears about the collapse of the financial system. Example: financial news channels were filled with headlines about banks failing, investment firms collapsing, and stock prices plummeting. This kind of coverage made people feel as though the world was ending financially, causing widespread panic selling. However, long-term investors who ignored the fear-driven headlines and kept their portfolios intact did much better than those who reacted to the news. Lesson: when you let the media dictate your financial decisions, it can cloud your judgment. In times of crisis, ignoring sensational headlines and staying the course often leads to better outcomes. 3. The fear of missing out. FOMO. How media can encourage risky behavior. The media often promotes a sense of urgency to act quickly and invest in the latest hot trends. This fear of missing out, FOMO, can pressure people into making investments without thinking through the risks or understanding the long-term consequences. Example: the 2021 GameStop short squeeze. In early 2021, media outlets, including social media, reported extensively on the GameStop stock rally, where retail investors on Reddit sent the stock price soaring in a short squeeze. News outlets praised the underdog investors and highlighted how much money people were making in a short period. Many retail investors jumped in without understanding the risks, hoping to replicate the gains, but the stock later crashed, leading to significant losses for those who bought in at the peak. Lesson: media can sometimes hype trends and create a sense of urgency that causes people to make emotionally driven investment decisions without understanding the risks involved. Patience and research are often more important than following the crowd. Why media and financial news can mislead you. 1. Sensationalism sells. Media outlets need high engagement, which means they focus on stories that grab attention, like market crashes, hot stocks, or once-in-a-lifetime opportunities. This creates a distorted view of reality, where investors feel they need to react immediately. Long-term wealth is built through consistent, steady investment decisions, not quick reactions to headlines. 2. Focus on the short term, not the long term. Financial news often focuses on short-term movements and forecasts, which leads people to make decisions based on temporary market shifts. Wealth is built over decades, but media stories rarely emphasize long-term strategies. 3. Emotional manipulation. Fear, greed, and panic are powerful emotions that the media often taps into. Fear of missing out, FOMO, and the urge to act now are key emotions that drive decision-making, but they often lead to poor investment choices. For example, when market crashes happen, the media's panic-driven coverage can cause people to sell their investments at the worst possible time. 4. It's not about timing the market. Investing success is about staying in the game long enough to benefit from compounding. Media outlets often create the illusion that timing the market, making big, short-term moves, will yield high returns. In reality, timing the market is nearly impossible and often leads to poor decisions. How to protect yourself from the influence of media. 1. Limit your exposure to financial news. Don't let the constant barrage of headlines dictate your investment decisions. Set aside time to review your financial situation without reacting to daily news. 2. Focus on your long-term goals. Base your decisions on your long-term financial goals, not on temporary market fluctuations or media hype. Example, if you have a 20-year investment horizon, don't panic over a one-week market drop. 3. Understand the risks of chasing trends. Don't make impulsive investments based on a hot tip from the media. Do thorough research before jumping into any new investment opportunity. 4. Stay calm during crises. Media often amplifies the worst during a crisis, like a market crash or financial downturn, but remember that financial markets recover over time. Reassure yourself that short-term volatility is normal and stay invested for the long term. 5. Use trusted sources of information. Rely on trusted, long-term resources for financial advice, such as books on personal finance, professional advisors, and well-established financial research. Avoid getting caught up in sensational headlines or social media trends. Final thought. While financial news and media outlets are important for staying informed, they often present a distorted, short-term view of the markets. In order to build long-term wealth, ignore the noise and focus on your own financial plan, goals, and steady investment strategy. Key takeaways from the book. Having more money won't make you rich if you spend it all. Being a great investor is not about intelligence, but about patience and discipline. Money buys freedom. Use it to control your time, not just to buy things. Know when you have enough. Don't risk everything for more. Investing is about staying in the game long enough to see compounding work its magic. Final thoughts. The psychology of money is not about complex financial theories, but about how human behavior impacts financial success. Housel emphasizes that understanding our own biases, emotions, and habits is more important than trying to outsmart the market. If you understand the psychology of money, you're more likely to make wise financial decisions that will benefit you in the long run.